Thank you very much for taking the time to be with us here today. We're very excited to have Jason Kingston with us for the second webinar in our Wealth Stewards webinar series. Jason is one of the principal accountants at Juilliard Sambrook Kingston, or DSK for short. He has an amazing wealth of knowledge and a unique experience in Canadian and US tax issues that's not common to find. Prior to DSK, Jason held positions as a business practice consultant, senior accountant, and COO. He became a graduate of CGA in 2005 and has also owned and operated Kingston Data and Credit since 2010. At the end of his presentation, we will have time for a question and answer period. So if you have any questions, please type them in the chat in the webinar, and they'll be addressed at that point. So without further ado, I'm going to let Jason take it away. Thank you.
Good afternoon, everyone. I hope you're having a great day. So today I wanted to talk about some of the new rules that are coming down the pipe, specifically as they relate to passive investments and the small business limit. So the small business limit relates to Canadian-controlled private corporations, which I believe everyone on the webinar is either a business owner or a business consultant. So these are going to be very important rules to be aware of on a go-forward basis. So, tax planning using private corporations. As anyone in the tax accounting, finance, small business world in Canada should know, since we've had our current government in place, they have taken issue with small business and with perceived advantages that small businesses were using. So in 2017, the Department of Finance proposed new legislation that would have a lot of impacts on small business. There were public consultations that were the result of a fairly substantial public outcry to the white paper that Department of Finance dropped in the summer of 2017. It's very rare in Canada that the news of a tax update results in an outcry, but in this case, it very much did. Business owners, tax consultants, wealth management, everyone got rather upset and pushed back hard against the government. So the government did launch consultations and took some time to re-examine the rules that they were coming out with. What it boiled down to in the 2017 proposals is there were two areas that they wanted to look at. One was tax on split income, and the other was the passive investment rules. We're not going to spend a lot of time on TOSI, tax on split income. I wanted to focus on the passive investment rules today. But TOSI, they did come back on just recently. They passed rules this past summer to implement tax on split income, which affects dividends, interest, capital gains even, or shareholder benefits that are being paid out of private corporations to family members of active shareholders. So the days of mom being a doctor setting up a medical professional corporation and giving dad non-voting dividend streaming preferred shares and dad taking $100,000 in dividends a year, that's what the government found offensive, and that's what the new TOSI rules are applying against. So dad in today's world would be taxed at the highest tax rate, so about 46% on non-eligible dividends on that income instead of on his marginal tax rate. So it's a very significant tax hit. The other rules, and the ones that we're going to focus on today, though, are the changes to the passive investment rules. So the current government's of the opinion that the owners of private businesses were experiencing a benefit by investing income that had been taxed at the small business tax rate. As we all know, CCPCs, Canadian Controlled Private Corporations, that are engaged in an active trader business pay tax at a reduced rate on the first $500,000. That's the small business deduction. That's the amount that, from a policy perspective, the argument is by taxing the small business at a lower rate, that leaves additional money available to reinvest in the business. Instead, though, a lot of people are using that tax savings and investing in passive assets that are then going to be used for many other purposes. Currently, the small business tax rate in Ontario is 13.5%. That's slated to go down due to a decrease in the federal small business tax rate. In order to eliminate the perceived benefit, Budget 2018 introduced new rules to reduce or eliminate the low rate of tax in corporations where they or other corporations associated with them have passive income in excess of $50,000 in the tax year. So we will touch on all those things in more detail. The reduction of the small business deduction is based on a new tax term and that new tax term is adjusted aggregate investment income. The reduction starts when AAII is $50,000, and at that point, the small business deductions reduced by $5 for every $1 of AAII that is over $50,000. So therefore, the $500,000 small business deduction is completely eliminated when AAII reaches $150,000, because that at 1 to 5, it takes 100,000 of AAII to eliminate 500,000 of the small business limit. AAII is based on the taxation year ended in the prior calendar year and includes all corporations associated in the current year. So, for example, if a corporation, sorry for the typo, has a calendar year end, the December 31st, 2019 clawback will be determined based on AAII earned in the December 31st, 2018 taxation year. There's a bit of a trap in here, and on the surface, it's probably a little frustrating that last year's passive income is affecting this year's small business rate. From a practicality standpoint, though, it's likely good, because otherwise we would be waiting on T3s, T5s, passive income reporting information in order to determine the current year AAII. And on an off-calendar year end, where the slips aren't being produced for another X number of months, that could become quite the chore. So from an administrative perspective, it probably does make it easier that it's last year's AAII that's going to be drawn into account in the current year. The trap that I mentioned, though, is based on it includes all corporations associated in the current year. So that means if a new corporation enters the mix and becomes associated, let's say in the December 31st, 2019 period, then any AAII that corporation had in the prior year, even though the two corporations weren't associated in 2018, still gets taken into account of the 2019 calculation. So we will have to be very careful when we're looking at acquisitions, if we're looking at even marriages. So say wife has an operating company and dad has an operating company, they meet, or husband, they meet, they get married, and then because we're smart accountants, we do some kind of reorganization to allow cross ownership, because small business deductions, whatever, we come up with good reasons, but we create association between those two corporations. We now have to look at the impact on AAII. So there's going to be some additional thoughts going into that. The reduction is effective for taxation years starting after 2018. So for calendar years, we're getting to the point where they now apply with fiscal years starting January 1st. However, the rules will also apply to a taxation year of a corporation that begins in 2018 and ends in 2019 if the preceding tax year was, because of a transaction or event or a series of transactions or events, shorter than it otherwise would have been, and one of the reasons for the transaction, event, or series was to defer the application of the changes to the small business deduction rules to the corporation. So, in other words, undertaking transactions to cause a short fiscal year in order to avoid the implementation of the rules a little longer won't work. If you do anything, even just a simple change of year-end request, and come up with, these are the reasons we want to do it. If CRA comes back and says, no, the reason you wanted to do this was to avoid the new small business deduction rules, you would be into an argument with CRA, and the rules could then apply earlier than what they otherwise would have. So you will have to be careful at looking at any change in year ends if there are corporations within the associated group that are earning passive income. Now, AAII, this whole situation is predicated on the idea of associated corporations and the associated corporate group. So just a quick one-pager review of associated corporations. So corporations are associated when one corporation controlled directly or indirectly in any manner whatsoever the other corporation. If both corporations were controlled directly or indirectly in any matter whatever by the same person or group of persons. Each corporation controlled by a related person and 25% or more cross ownership. So remember, related is related by blood or marriage. So spouses, children, grandparents, usually direct linear. One corporation controlled by a person who is related to each member of a group that controls the other, and 25% or more cross ownership by the person. or each corporation controlled by a related group, each member of one related group related by all members of the other, and 25% or more cross ownership by the person. So it may be worth, if you have a corporate group, or if you're consulting with clients that have corporate groups, just be aware if they're a minority shareholder and you weren't sure if a corporation was associated in the past. Depending on the circumstances, sharing of small business limit is also based on association, but maybe it wasn't a huge deal. So, there are some groups where I can see being a little lax in determining association, but now we're going to want to be tight on that. We're going to want to clean that up, make sure that you're very aware of all associated groups. And these are just the basic rules. There are the additional association rules that we're going to have to be careful of. Things such as when dealing with a discretionary trust, all beneficiaries of the discretionary trust are deemed to own 100% of all shares that trust owns. So most family trusts are discretionary trusts. So if you have adult children and they're beneficiaries of that trust, and then that trust owns, say, mom and dad's operating company, but then son goes and has his own operating company, under the association rules, son's company and mom and dad's company are associated due to the look-through trust rules. Also, there are rules around options. If there's an option that would allow control of a corporation to be taken, then in circumstances that could create an association. So there are complex rules that need to be very much taken into account here. So once we have an associated group, we have to determine the adjusted aggregate investment income of the group. This is the wording that is put into the Income Tax Act. So Section 127 or 125 sub 7 of the Income Tax Act defines adjusted aggregate investment income. And in this definition, one of the very first things it does is then says, this means, with modification, the amount that would be aggregate investment income as defined in subsection 129 sub 4. So as a tax advisor, as a business advisor, or as a business owner who's insane and decides to read the Income Tax Act, you start at 125 sub 7 and you're reading along and life is good, and then it refers you to 129 sub 4. So you go over to 129 sub 4 and there's a whole lot more words. And you start reading 129 sub 4 and then you forget exactly what it's referencing. So you go back and you start reading here, and then it jumps you back. So you go back to 129 sub 4. And then in my case, if you're in my office, you go to the Scotch collection and you start with the Highland Park 18, because at this point you haven't given up complete hope on life, but you start drinking. And you go back and you read some of this, and hopefully it makes a little more sense because you've had some scotch. So you finally really nail down 129 sub 4 aggregate investment income. Come back here, you start reading through, and then as you can see, there are just a ton more references throughout this definition. So we're not going to read these definitions because they do boil down to a plain English definition to a degree, and that is my Scotch collection in the office. If you haven't had the chance to visit me and you like Scotch, drop me an email. Maybe we can have a drink one day. So, adjusted aggregate investment income in English. Aggregate investment income generally includes the following type of investment incomes: interest, taxable capital gains in excess of allowable capital losses, rents, royalties, portfolio dividends, dividends from foreign corporations that are not foreign affiliates. So foreign corporations where you may have a minority interest. And that's coming up with your aggregate investment income. So that's kind of the starting point of the calculation. So you mostly add all of these things together, and then you have to do key adjustments to go from aggregate investment income to adjusted aggregate investment income, AAII. So AAII does not include capital gains or losses on assets which are active assets at the time of disposition. Active assets are assets used actively in a trade or business. So that would be your vehicles on running your business. If you own real estate that your business is run out of, assuming that your business is the majority user of that real estate or the sole user of that real estate, then that would also be an active business asset. So if you do sell it and realize a capital gain, those gains are not included in AAII. AAII does not include capital gains or losses carry forward or backwards from other taxation years, and that gets to be a key point in a few minutes. And AAII does not include dividends from connected corporations. So this would be a situation where you might have your standard holding company owning the shares of an operating company. The dividends from that operating company are not considered AAII when they're paid up into the holdco. And then AAII includes income from a specified investment business carried on outside of Canada. So you can't get around these rules by setting up an offshore investment business. The first point with the capital gains or losses on active assets, that would also include the situation where a holding company owns the shares of an active company subsidiary. The government made a big deal of protecting angel investors and venture capitalists when determining these rules. That was, probably one of the sound bites that was played in the news quite a bit. And this is their way of doing that. So those shares, because they are shares in an active business, generally speaking, a venture capitalist or an angel is going to have a fairly substantial holding when they put that kind of money into a business. So that would be considered an active asset. So when it is sold for a capital gain, these AAII rules won't apply. So taking the above into consideration, the most basic calculation of AAII is the amount by which taxable capital gains exceeds allowable capital losses for the taxation year, in both cases excluding gains or losses on active assets. The amount cannot be less than zero, and that point becomes quite important too. Add to that income from property, excluding exempt income not subject to Part 1 tax, and deduct losses from property for the year up to the amount of income for property for the year. So now you could be in a situation where you have capital gains from selling assets and you have other property income, be it dividends or interest or rental of passive real estate, which itself may be in an income or a loss position. The calculation is based on those two parts. So the amount that is taxable capital gains exceeding allowable capital losses, that's the first part, and it can't be less than zero. The second part is the amount by which other income for property exceeds losses from property, which also cannot be less than zero. So here's a trap. As such, a loss in one portion cannot offset income in the other, nor can the total loss be less than zero. So, for example, a corporation experiences a capital gain of $1,000 and a rental loss of $1,000, so negative $1,000. The rental loss cannot be less than zero, so it's deemed to be zero. Therefore, the corporation has adjusted aggregate investment income of $1,000. Has taxable income of zero, but it has AAII of $1,000. So you could actually be in situations where a corporation has no taxable income, has no current tax payable within that corporation, but it is contributing AAII into the associated group, which could be causing a clawback of a small business limit in an active operating company. Losses of other years are not included in AII or AAII. So while a loss carry forward or carry back may reduce taxable income in the year, they will not reduce the income included in AAII. It's therefore possible to have no taxable income in a year, but still have a reduction in the small business deduction in the year following. So that's one thing. Historically, we've been maybe a little less concerned about the timing of our capital losses, unless we knew we needed them to offset capital gains. So tax loss selling, I'm sure that's a phrase most of us are familiar with, was done. But if we had a capital loss, we weren't necessarily excited about generating a current year capital gain to offset that loss, because the loss would just be carried forward and we would use it when needed in the future. But now that carry forward capital loss, while it will still reduce taxable income, it will not reduce AAII in the future. So under these rules, we may suddenly be much more concerned about making sure capital losses, when realized, have a capital gain realized in the same year. So that's going to create a lot of additional planning work, especially in holding companies that are holding liquid assets, so that we maybe can do some maneuvers to generate capital gains. Obviously, if you're dealing with real property or more major assets, there's only so much you can do. But if you have an investment portfolio, and this is where very good communication between investment advisors and tax advisors is going to be important. Since the AAII of a corporation cannot be less than 0, current year losses in one corporation can only reduce AAII in that corporation, not in associated corporations. So let's think of a structure where the shareholders, let's say mom and dad, own all the companies equally, 50-50, and they have an operating company, they have a real estate company that's renting passive real estate to third parties, and they have an investment company that is that has liquid cash assets that are generating income. So the operating company makes active business income. The investment company generates capital gains, dividends, interest income, all that good stuff, and therefore is generating AAII. But then the rental income company, let's say it has rental losses this year. There's lots of repairs and maintenance or whatever the case might be, and it goes negative. Well, now we have a situation where that corporation's AAII, even though it has a loss for accounting purposes and for tax purposes, cannot be negative. So it becomes 0, even though investment company has positive AAII. On an associated company cumulative basis, it's only that positive AAII that now gets taken into account. The loss in the rental income property remains 0. Therefore, we're possibly creating a clawback situation in the operating company, depending on how much passive income is generated, if it's more than $50,000. And I forgot to mention this earlier, but the logic behind the $50,000 was that would be the rate of return on $1 million of invested, and that if you have more than $3 million invested, that's the 150. They're assuming a 5% rate of return. And I guess if you have $3 million in passive assets, then you're rich enough that you don't need to accumulate anymore. I'm hoping Mr. Marneau will donate all of his wealth above $3 million and maybe prove that point. But as of yet, I haven't read that in the papers. So. Now, there are anti-avoidance rules are associated with these as well. We already mentioned one. So the first one is the short business year. If a corporation creates a short year end in order to delay application of these rules, the rules apply 1 year early, so you don't get out. So much for that. The other one is if a corporation lends or transfers property directly or indirectly by any means whatever to another corporation, and the two corporations are related but not associated. So related corporations could come into play where I have a corporation, my wife has a corporation, but we don't have cross ownership. But because we are related, our corporations are related, but they are not associated. And it may reasonably be considered that one of the reasons was to reduce the AAII business limit reduction, then the two corporations are deemed to be associated solely for the purposes of the AAII business limit reduction. So the example here is dad owns 100% of Dadco, mom owns 100% of Momco. Since mom and dad are related, the corporations are related, but since there's no cross ownership, they're not associated. If Momco loans Dadco funds, and Dadco then invests those funds and generates investment income in Dadco, that investment income would not reduce Momco's access to the small business deduction because the two corporations aren't associated, right? So it's not generating AAII that would be part of an associated group. However, the anti-avoidance rule in subsection 125 sub 5.2 is designed to prevent these transactions. The subsection applies if one corporation lends or transfers property directly, indirectly, by means of a trust or by any other means to a related corporation, and it may reasonably be considered that one of the reasons was to reduce the AAII of the corporation or an associated corporation. If this subsection applies, the two corporations are deemed to be associated solely for the purposes of the investment income business limit reduction. So, my favorite part of income tax is when things are subjective. So as soon as I read provisions that include may reasonably be considered, that's pretty much as subjective as we get. You may be able to come up with other reasons, legitimate reasons for why an asset would be transferred between related but not associated corporations. And depending on how you do it, the corporations, as long as they're not associated after the transfer, if you're doing it for creditor proofing purposes, to me, that's a legitimate business reason to be doing that. The fact that AAII might be reduced might just be a happy secondary circumstance of that transfer. But at that point, we are definitely, I believe, opening the door to arguments with CRA. And since these are new rules coming in now, we are going to be many, many years before we have judicial guidance on any of these things. So we're going to have to be very careful if we're looking at asset transfers between related corporations for the next few years, if any of those assets are generating passive income. So now the question is, what can we do? So these rules are here. They've been spelled out. What do we do to try to mitigate things for ourselves and our clients? The first is to reduce net investment income. So we take all the money out and put it in our mattress. We no longer have investment income. Life is great. Wealth Stewards maybe isn't the happiest with us because we've taken all the money and we're sleeping on it now. But that takes care of the problem. Well, no, there's other ways we can actually do that. If since AAII is calculated on net income, net of expenses, it's important to make sure all allowable expenses are captured first off. So this could include interest paid on funds borrowed for investment counsel fees, or a reasonable salary paid to owner managers. So that's one thing right now. If you have an associated group, owner manager may be taking all of their compensation out of an operating company, especially if it's needed to reduce net income down to the 500,000 mark, and maybe not taking any salary out of the holding company that's generating passive income. It may be worth putting some salary into the investment company. Arguably the owner manager is spending time dealing with the investments, dealing with the operation of that company, the administration of that company, so you can justify a reasonable salary paid to the owner manager, reduce the passive income, reduce the impact on AAII. So that's an option. Avoid earning investment income within your corporation will reduce AAII. So again, we're back to turning your dollar bills into mattresses. Or we can take a look at other structures. So these include things such as individual pension plans, and retirement compensation arrangements, or exempt life insurance policies. So in each of these cases, there's still an investment portion. There's still growth going on, but there's certainly more complication involved. But the money growing in an IPP, the IPP is itself a separate trust. It's set up as a trust arrangement. Same with a RCA, retirement compensation arrangements. Even though the corporation is making the contributions to it, it's not really an asset of the corporation. It's its own separate legal trust. And then exempt life insurance policies. There are a lot of good corporate life insurance options available, of which other speakers are way more knowledgeable than I am, so we'll leave that to them. But I think we are probably going to see an increase in the amount of corporate-owned life insurance and in the amount at looking at individual pension plans and even RCAs. So RCAs have, I think, largely been out of favor over the last couple decades, but I can see a growing use for them going forward. As a side note, Morneau Charpel, you might recognize the first name in that company, I believe is one of the country's largest providers of individual pension plans and RCAs and other such retirement vehicles, but I'm sure that had nothing to do with these rules coming into play. One of the other things we can do is defer realization of investment income to a time when there's lower or no active business within the corporate group. So this could be done by investing in assets that will appreciate in value instead of paying interest or dividends. This could be your corporate class mutual funds. That may be a simple solution depending on the situation. As we all hopefully know, corporate class mutual funds, they increase in value and all the income is recognized at the time of sale when the units of the corporation are sold, as compared to a traditional mutual fund trust that is distributing the income on an annual basis. There can be some issues with that, especially if you're dealing with U.S. shareholders or U.S. individuals that are directly owning those investments. They definitely have some cross-border context issues. And then the other thing is to try to time passive income to be realized in the same year where there are investment losses. So this would be where you may have capital gains and losses. You've generated a capital loss. For whatever reason, we may want to look at generating a capital gain in the current year to help keep the AAII lower. And that is actually it for the content. It's not a huge topic, but it's a topic of, I think, huge importance. So, Shelby, I think if there are questions, if people want to think of their questions.
Thank you very much, Jason. That was very informative. We do have some questions, but if anybody else has any, please feel free to ask them now. This is your opportunity to clarify anything that you'd like clarification on. So to start off, one question. So a father sold an operating company to the daughter, but kept the real estate company, which owns property that's 100% used by the operating company. The companies are associated, so is the net rental income in the real estate company AAII?
No. So the AAII rules won't apply to income that is recharacterized as active business income. So as long as these two corporations are associated, then I think it's a rule under 125. I forget specifically which rule it is. The rental income is reclassified as active business income if it's being received by an associated company that is renting the building. So therefore, it's outside AAII as long as those two corporations are associated.
Okay, great. Thank you. And another question. Have you seen any indication of potential changes to the taxation on family trusts in regard to future or in the future regarding investment income?
No, I'm not sure. The author on that one, if they have any clarification points, they might want to throw that out. The trust rules, I mean, largely changed a few years ago when we got rid of the progressive rates on testamentary trusts. Inter vivos trusts have always been subject to the highest rate of tax. The kind of impact on the tax or on the trust structures right now is more to do with the tax on split income, because trusts were being used largely as income splitting vehicles. And if you're paying dividends to a trust that are then distributing them out to non-active or individuals who aren't active in the business that are paying the dividends, you have a tax on split income issue, but not so much on the taxation of the passive incomes themselves. Like, I would still use trusts in the context of moving money from an operating company. Let's say mom and dad are active in the company, adult child A, adult child B aren't active, but the operating company is accumulating significant value in terms of being saleable. And then it's generating excess cash flow that we want to move over to an investment company for mom and dad. I'd still consider a family trust structure that the dividend flows up to the trust. It can be allocated out to the investment company. And then when the shares are sold and capital gains exemptions can be used, we can still use mom, dad, and adult child A and B, because the TOSI rules don't apply to capital gains, to which the lifetime capital gains exemption applies.
Great, thank you very much. Just one final question then. You'd mentioned that IPPs could be used as a prudent strategy for limiting AAII. Are you familiar at all with life settlements, or have any comments on life settlements as a strategy to lower AAII for associated corporations holding significant investments?
Yeah, life settlements should be an option. So if there are any callers that aren't familiar with life settlements, and I'm not an expert on them myself, but the idea of life settlements is individuals who determine that they no longer have need of a life insurance policy, instead of canceling that policy and letting the insurer keep all the money that they've received in premiums over the year, will instead sell the policy to life settlements. And life settlements does the actuarial analysis to determine how much they're going to pay, and then up front, and then they take over the premium payments. When the individual who sold the policy, who remains the insured, passes away, the death benefits paid out to life settlements, which then can distribute to the investors. And life settlements uses a pooled fund. As such, under current Canadian tax rules, the proceeds of life insurance policies, the death benefits, are exempt from tax. They are not subject to Part 1 tax. So within the life settlements context, since all the income is coming from proceeds of life insurance policies, it should be tax exempt, and therefore income that is exempt from Part 1 tax does not fall into aggregate investment income, AIII. And if it's not AII, it is therefore not AAII. So under the current rules, life settlements should also avoid any application of these rules.
Thank you very much, Jason. If there are no other questions, then that does bring us to the end of the webinar. Thank you very much for everybody who's joined us. We'll be sending out PD certificates to those who are online, and our next webinar is going to be in January. We'll send out more information relating to that as we get closer to the date. And a recording of this webinar will also be available to all attendees after the fact. Thank you very much, Jason, for your time. We really appreciate having you here and hope that everybody has a great day and an excellent holiday season.